Good morning. I maybe should start. Good morning. Welcome to you who have connected to our workshop. When I say our workshop, is the ecoDa PwC workshop on internal control, corporate reporting, and internal control as the possible way forward. My name is Rogier Wezenbeek. I work at DG FISMA, the DG of the Commission, European Commission. I'm sitting here with a distinguished panel, and I have the honor of being the chair of the moderator today of 4 real experts. I'm sitting here with Anne-Helene Monserrato, who is an independent director who has a lot of experience, a wealth of experience in audit and risk management committees across the US and the EU. I'm sitting here with Rachel Bowden, who is a consultant and an expert on risk assurance and governmental specialist. A lot of experience in terms of audit committee. Also here is Stephen Lysons, who is a group chief internal accountant at Legal and General, who has also a very extensive experience as an internal auditor. And I'm sitting here also with Maurizio Donfito, who is from PwC and European, and he's chair of the European Contact Group, and who is an auditor and has also an incredible experience. As I said, my name is Rogier Wezenbeek from the Commission. Audit, internal control is of course quite an important topic, in the sense that when we issued a market monitoring report early this year, we discovered that when you look at audit quality, one of the most deficiencies which are occurring are around the effectiveness of internal control quality and control systems. And it's a theme which we think should be strengthened. We have issued a public consultation earlier this year about the strengthening corporate reporting, corporate governance, audit and oversight. We have published a consultation about that. We are in the process of thinking what to do next. We have it's still in the process, but it's clear that corporate governance ought to be strengthened. The way to do it, we have still again discussing, but internal control is an important element thereof. We have asked some questions in that public consultation about the role of boards, of directors, the role of the audit committee, and the role of oversight. And I think on all the issues, comments were that some changes ought to be made, and maybe we should draw some lessons from what the US has been doing, the plans in the UK and other jurisdictions. And I think before going talking more about that myself, I think I would probably give the floor to Anne-Helene, and maybe she can tell us a bit what we understand by internal control, especially in the European context, and whether there's a kind of common understanding among the European member states. Anne-Helene, if you want to take on to come on board.
Thank you. Thank you, Roger. And just by way of an introduction, complementing what you just said, beyond being an experienced audit committee chair on dual listed companies listed in the EU and in the US, before that, I was also heavily involved in PCAOB SOX 404 audits from both an implementation standpoint and as an auditor, and that for over 10 years. So what about internal control in the EU? My key message is that to you maybe is that what is expected from companies and from audit committees is not clear regarding internal control. Before, in the 2006 directive, it was monitor the effectiveness of the company's internal control, internal audit as applicable, and risk management systems. And in the 2014 directive, this has been reduced to internal control over financial reporting, but with a wording which makes it not very obvious or transparent as to what is required. And now it reads, monitor the effectiveness of the undertakings, internal quality control and risk management systems, and where applicable, its internal audit regarding the financial reporting without breaching its independence. So the without breaching its independence is very important, because it means to me as an audit committee chair that management has to do something and implement a process. And if this is now widely taken as meaning internal assessment of internal control, although it's written internal quality control. So here, this is where it's not clear. And when we start wondering what it means for a company, I must say now that there is a before and an after SOX. SOX 404 in the US regarding assessment of internal control. And what happened with SOX is that more than 20 years ago now in the US, they started with a fairly not basic concepts. Now it's more in the regular flow of how you do things for audit committees in the US. But basically, they have a framework which is COSO, which is robust and simple to implement. And there is a systematic assessment of internal control over financial reporting. And what does it mean? It means that first that you have a scoping exercise. You have an assessment of what is material in your financial statements. And you have a documentation of internal control, which means very basically a narrative, a flowchart, and a risk and control metrics. And this is documentation. And then you have a testing plan with enough details about what is being tested. This is done once a year for all controls deemed key. And there is an assessment of the severity of the deficiencies from all sources with appropriate remediation and follow-up. So once you trained, I would say, in your way of doing things to do this once a year, it's embedded in the way you work in a financial department, and it's also very easy to duplicate. For example, in operations, or tomorrow when we'll have sustainability reporting, it will be much easier to have a sound and robust internal control around the metrics that will be, and qualitative information that will be required for sustainability reporting. So my key point here is that we have had in the EU two different types of companies which have implemented internal control in a SOX type manner, I would say. And these are the large subsidiaries of companies listed in the US, or European companies listed in the US, or foreign private issuers. And for those companies, it's super clear about what internal control means, crystal clear to them. And for European companies who do not have that background, I would say, they're lacking, unless they are on the voluntary implementation, they are lacking this very broad, systematic, encompassing definition of what internal control means. And in a sense, for me, they're lacking something, and it makes lives, and maybe we'll talk more about that in a few moments, but having a company implementing a true system of internal control, considering what I just said about the mission of the audit committee of monitoring the effectiveness of internal control, it makes lives of governance much easier.
Many thanks, Anne-Hélène. I think we start to understand what the issues are. And I think you're very right in pointing out that the landscape is changing, in the sense that the limitation to financial control, financial reporting is probably to go be broader. It's also sustainable reporting, and under the corporate sustainable reporting directive, there will be new standards being developed and all that, and the scope should probably be broader. But without further ado, I would like to give Stephen the floor, because he's a real internal auditor, and I think better if you can explain a bit from your experience how you see the role as an internal auditor and internal control. Over to you, Steve.
Thank you, and good morning. Good morning, everybody. I just want to say thank you to ecoDa and PwC for inviting me today to join this panel. As Roger alluded to, I'm the Group Chief Internal Auditor of Legal & General Group PLC in the UK. I've been with this group 8 years, but I've been working in internal audit for around about 30 years now. So when I was reflecting on the discussion today, I was just thinking I've spent quite a lot of those 30 years trying to untangle what internal control actually means, what does that mean for us in internal audit, and what does it mean for the future. So it's a very topical subject for me. I think just before I do go on to talk about internal control, I think it is worth just saying, what is internal audit? And I won't kind of spend too much time on that, but it is worth just clarifying that, because terms like internal audit, internal control over financial reporting are very often used intermingledly. And my experience over the years has shown me that depending on what sector you're in, what industry you're in, what country you're in, all of those terms can mean something very, very different. So I think it's worth just reflecting on what I think internal audit means and what I think internal audit isn't. So I'd start off by saying that internal audit is actually a function, it isn't a process. So very often people say there's an internal audit and it's somehow some kind of process. Well, yes, there are processes that get audited, but internal audit isn't a process in its own right. So it is actually a function, and it has a purpose within organisations. It's very well defined in some organisations. It's more well defined in large listed companies, but really, and within financial services, which is the sector I'm very familiar with. So in terms of what is internal audit, it's there as a support mechanism, support vehicle for the board and senior management. It's there to identify risks and make sure that those risks are well understood and reported to the board. And it's there to fundamentally protect the assets, reputation, sustainability of the organisation. And within that, internal audit is responsible for giving an opinion about internal control. So fundamentally, internal audit is part of the internal mechanism. But even saying that, internal audit isn't always part of the organisation itself. Many organisations still outsource their internal audit function to third parties like PwC, EY and others. So again, just understanding what internal audit's role is, how it's structured, what its real purpose is really quite fundamental. The reason why I raise that is then fundamental to understand what internal audit can do as part of the internal control system. So whilst that's really important to understand that, what's internal audit's role in internal control? Well, it's part of the assurance process to the board that those systems of internal control, as designed by management, are operating in the way that they are intended to do, and provide advice on whether they are fit for purpose, whether they're meeting the purpose of the risks that are posed by the organisation. And a subset of that is actually looking at internal financial controls, because of course, in many organisations, the two are very interlinked. It's very difficult to disaggregate things like IT controls from their own kind of objectives around keeping the organisation safe and secure, to how those controls actually operate and have influence over the internal controls over financial reporting. So actually differentiating the two is really important. But fundamentally, the role of internal audit can be different. It's really important that in any regime that's developed, that the role of internal audit is recognised, and that really the boundaries of the internal audit process within the internal control systems are well understood.
Okay, I think that's, thank you. I think that's very clear. I would like now to turn over to Rachel. And I think maybe you can also bring in an even bigger perspective from the UK on how internal control is done, and what the plans are to enhance internal control, and what's expected to change in terms of responsibilities of non-executive directors. Rachel, you have the floor.
Great, thank you, and thank you ecoDa and PwC for inviting me. And I'd just like to echo some of the things that Stephen said. Actually, I'm also an internal auditor, although I'm here today really with my non-executive director and audit committee chair hat on. And the role of internal audit does vary. I think it will be interesting to see in the UK, as some of the things I'm about to mention get embedded, how we see a type of internal audit approaching that. So in the UK, in March 2021, the UK government published a consultation, and it was called Restoring Trust in Audit and Corporate Governance. Really high profile, very good response and engagement levels, type of from various different type of groups, and it was really type of good to see how much discussion that generated. We had to wait quite a long time for the government's response, which actually came May this year, so type of 15 months after that initial white paper. And to be fair, the government have watered down some of the initial things that they put in that white paper. So there's far too much. We could do a whole webinar just on that. But just to pull out some of those areas that are specific to internal control, just a few things to mention that almost provide some wider context is that the government is type of reinforcing its audit regulator. There's going to be a new audit regulator taking over from the Financial Reporting Council. It's going to have a statutory footing with greater legal powers, and its scope is going to widen as well. So it won't be just thinking about the external auditors, those auditing the financial statements. It'll also be thinking about what directors do as well. The UK government also widened the definition of public interest entities instead of just being listed entities or premium listed entities. And I think really for the purposes of this, and spent a lot of time thinking, there's been a lot of reviews in the UK about the external audit market, move maybe towards some shared audits between larger and smaller firms, and separating the type of consulting and audit arms of some of the largest firms. So that's, I think, some useful background, but two things that I think are very specific to internal control to focus on here really was, firstly, and this wasn't watered down, this will stay, and I think this is a great idea, that public interest entities should have an audit and assurance policy. And that should explain how the board and the audit committee seek and use independent assurance, and also the scope of that. So it needs to describe its internal auditing process and its assurance process. And to those of you, and I'm sure there's many in today's audience that for which risk and assurance is something we think about a lot, I think this lends very well to the 3 lines model, used to be called the 3 lines of defence model. And for me, I genuinely think in the UK, we will see this go wider than just public interest entities. We've seen in the past some corporate governance initiatives that have been aimed at listed companies have actually worked really well in the public sector and government. And I suspect we will see audit and assurance policies rolled out generally. I think that's a really good idea. And for me, that really then links to what do we mean by internal controls? And that goes back to, I think, the discussions that we've already heard today about maybe the lack of consistency, maybe about what people perceive internal controls to mean. What we were expecting came out in the initial consultation was what we would basically have called UK SOX, to be honest. You know, some external statements and assertions and expecting some assurance. There was really strong support for strengthening the internal control framework in the UK and an explicit statement from directors. So that remains. The non-executive directors now will have to have responsibility. And for me, I think one of the key things will be the whole board understanding their role and not just seeing that as the domain of the audit committee. But it's been watered down in that there's now no longer a mandated requirement for assurance on that external statement. So I think that's really quite interesting. And I think, and I'm sure we'll get to that as the discussion goes on, we'll get to where that comes through. Something else to mention is going through the UK Parliament at the moment, there's an economic crime and transparency bill. Now, it's really to do with dirty money and money laundering, but there's a couple of all-party parliamentary groups which are adding amendments to that, really to try and make directors more responsible and actually accountable for if major fraud is found. Now, while they're thinking about money laundering, for me, we've seen in the UK some large corporate failures, And that's not about money laundering, it's about maybe poor internal control. And therefore, I think that's really going to focus, if those amendments go through, I think that will also really focus the attention of non-executive directors. I think that's probably all I'll say for now. Thank you.
Thank you very much, Rachel. Very interesting to have already some insights what's happening in the UK. We come probably back to that later. Maybe I'd like to give the floor to Maurizio, because I understand you are the chair of the European Contact Group, which is the largest 6 audit networks. That you have done some research about the European landscape. And can you talk us a bit or share your conclusions with us about the research being done at that level? Thank you, Maurizio.
Yeah, thank you, and good morning, everybody. Indeed, during the corporate reporting consultation process, which was concluded during the 2022, we, as European Contact Group, were diligent in responding to some of the questions of the Commission, but at the same time trying to respond on the call for audit for evidence about the corporate reporting and the corporate reporting issues. We noticed, and we were diligent in the exercise, so we were able to find evidence on the, as you know, the 3 famous pillars: governance, audit, and oversight. Were abundant in the audit and the oversight side, but we didn't find much evidence on the corporate governance. So we decided that in the interest of all the stakeholders and the consultation process, that probably was worth trying to fill this gap and trying to not come to a specific definitive conclusion. Obviously, it's not up to us to come to conclusion, but try to give a better picture and a better understanding of the overall EU governance framework for corporate reporting in Europe. So we hired an independent economic and finance consulting firm, which is expert in these fields. And basically, we came in a nutshell with some as a result of the research performed during the last several months, with some evidence that are, I think, of interest of the audience. The first one is the existence of a regulatory and legislative regime in Europe, which is somewhat different between member states around governance and governance implementation, particularly in the field of roles and responsibilities and attestations requested in the preparation and the publication of the corporate reporting of each company. So there are countries that have very stringent and detailed requirements, and some other that they have less stringent and clear requirements. And this is just itself I think an element on which we should all reflect, because if we want to come to a capital market union, we have probably to think about a common framework implemented across the world. But the second element that is coming from this empirical study is that those countries that have implemented more rigorous legislation in terms of clarification, roles and responsibilities, and in particular, are more prescriptive on the request of an adequate system of internal control over the corporate reporting. They had experienced, as soon as the implementation of this legislation took place in their countries, a reduction in the cost of capital, a reduction in terms of unusual accruals, adjustment, post-year adjustments, and also that there was some sort of more clarity in terms of the corporate reporting. So the experience is in terms of cost of capital, a substantial decrease or to a level that can be measured and quantified. And that this is an indirect, empirical indication that when some strong measures are introduced, the perception of the stakeholder, the stakeholder that finance the companies, they appreciate the lower level of risk, and so they are willing to accept a lower return. So in a nutshell, is an empirical study that tries to compare the introduction of measures that can be considered similar, unless but not equal to the Sarbanes and Oxley provisions in America. And we have a similar empirical benefit of what was the benefit gain in the American market in the early 2000s when Sarbanes and Oxley was introduced. So the study just wants to highlight the fact that yes, there are some costs that has to be paid in terms of complexity and system of internal control, but there are also some significant benefits, and these benefits were clearly measured in the American experience under the sandbox, and to a certain degree in those countries that had the similar, and not identical, but similar measures introduced in the local economy.
Can I maybe echo, maybe interpret it, maybe what you were saying is that we should look for some European solutions. I mean, if that's, I can summarize your statement, and I can also only echo that. But indeed, I think it's very relevant to look what other jurisdictions, in particular the United States, have been doing and are doing, and also the UK, what the plans are. But I referred already in my introduction remark that we have done in the EU a public consultation on the 3 pillars of corporate reporting. Again, corporate governance, audit, and oversight. There are clearly areas where we might want to strengthen the internal control component. And maybe I should turn to Anne-Hélène to see what think with your experience in the US and the EU. Working with dual listed companies, what would be how you would see that in Europe we should move forward, and what would be the benefits and disadvantages in terms of governance? Anne-Hélène.
Thank you, Roger. Indeed, I totally agree with Maurizio. There are many benefits to SOX type, again, not SOX US, but EU SOX, let's call it that way. If we had an EU SOX in the EU. From a governance standpoint, definitely it creates better conditions for financial statement preparation and financial statement audit. So as you know, for the audit committee is tasked by the board to oversee financial statement preparation and auditors, I would say, audit execution and auditors' performance. And auditors' performance is typically conditioned by the overall environment that they meet at the companies that they are auditing. So definitely, SOX will create better conditions for both preparation and audit. Why that? Because first, as was said, it's a systematic process and it's a systematic review of risks. It's not just, or I think there is a problem here, we should do something. It's we start with looking at all the material flow of transactions and having a systematic assessment of what could go wrong, where, and we need to do something. So it's not just, I think about this, we need to do something. No, it's systematic approach. Second point is that a SOX type exercise fosters a culture of risks and internal control within companies. First, they will gain a much better understanding of processes, and in particular processes participating to the preparation of financial statement. It's also an embedded process of, overseeing, looking at the processes, the internal control and the testing. When it's becoming embedded, it's not just a cherry on the cake. It's part of doing things as a normal way of doing business. There is a feedback loop, so it's always an iterative process. It's not perfect from the start. It's always evolving, responding to different risks, different areas where the company is expanded, different types of transactions. And it's also a better attention of at conditions overall of how people work. And in that way, it decreases a lot the culture of blame, I would say, and look at, you know, how things are performed internally in a much more constructive way. As I said, it's iterative, and that's a very good point about it. Another point I'd like to emphasize regarding those better conditions is that it provides for a factual assessment and the root cause in understanding what went wrong in the process. And this is done from all sources of deficiencies, be it from management assessment, be it from auditors' adjustments. For example, when you have an accounting adjustments on the financial statements, this means practically that something has been amiss in the internal control of the company. So you would look at all those different sources of deficiencies, analyze those, and then report to the audit committee. And obviously, if you report as a company to the audit committee, this is taken seriously in terms of remediation and follow-up. So the whole process of SOX is very virtuous to that extent. So that's the first point, creating better conditions. Second point is when you have a mission, as I explained, to the audit committee to monitor that effectiveness, you need to do something in terms of having management do something to allow the audit committee, tasked by the board, again, to fulfill its mission. So having such a process will put something, you know, for real behind what the audit committee is supposed to be doing. And the third point I'd like to discuss is the fact that this will protect your liability for management, but also for the board. Because if you need to do that, you need to monitor effectiveness, and you have nothing in front of it, you know, it's very difficult if you have a large fraud to say, hey, but we did pay attention to the internal control. If you have nothing to show for it, then, you know, it's very difficult for you to say that you have done something. And again, in a systematic basis, looking at all the processes at least once a year, not having internal audit looking at one or two processes important to the preparation of financial statement. Here, it's systematic. All key processes are looked in terms of whether internal control performed effectively. In terms of the disadvantages of SOX, so this was discussed by Stephen and Maurizio at some point. Yes, it's a little bit of an additional cost. A little bit of an additional cost because it means resources. It means having an IT system allowing you to understand whether control owners have performed their testing in a timely basis before, you know, auditors are coming, for example. But I would like to say two things here. It creates efficiencies, as Maurizio pointed out, efficiencies in terms of having had a look at all your processes. You are in a better situation to first rationalize your processes, making sure you do not have overlaps and so on, but also it creates opportunities for automation, digitalization of how certain things are done. And another way where you would have, where I would see very clear efficiencies in a SOX implementation is that in terms of hiring, when you have a turnover in your finance department, it will make it much easier when you have somebody new joining the team to understand very quickly what's he or she is supposed to do, what are the key points he's supposed to, key control he's supposed to make in terms of how he or she is working during the day. So final point, if it's important, if it's deemed important by everybody, then you need to have resources in front of it. So the point of its additional cost, for me, it's, you know, it's totally benefits totally outweigh those additional costs in terms of culture, how people work, reliability of the financial statement, less pressure in the overall financial statement process preparation and audit quality. So this is the key message in terms of how internal control and having a joint, shared, clear understanding of what internal control over financial reporting means how important this is for governance.
I think that's very clear. Thank you, Ellen. I would like to give the floor now to Stephen, because I guess you want to react on this. And I think you maybe want to reflect a bit on whether we should be mindful of what we should be mindful of when we devise an effective legislative framework for internal control from your perspective. May I also...
Yeah.
Okay.
Thank you. No, and I would absolutely echo the comments of Helena there, really. I think the important thing for me to absolutely recognise going into any new regulatory regime is that there are no silver bullets. I think, 20 years on from the implementation of SOX in the US, that didn't prevent the global financial crisis. It didn't prevent the collapse of Lehman Brothers in the States. It didn't prevent the collapse of RBS in the UK as a major global bank. And it didn't prevent the collapse of Carillion, a major construction company in the UK as well. So we have to be very realistic about what any form of SOX framework is and what it isn't. But having said that, one of the more surprising findings from the Kingman review, which was referred to earlier, which was about restoring trust in corporate governance in the UK, was that there was a very consistent message from the corporate world that actually the implementation of a SOX framework would be welcomed. There was some anticipation that wouldn't be appreciated, but I think it genuinely reflects how global the world is. The global business community is not focused on just Europe, the United States, the UK and Asia. It's intermingled, and many large organizations are extremely familiar with SOX and frameworks such as those in Japan, and even the corporate governance framework in the UK. These are not new concepts. So I think any attempt to implement a framework in Europe will only be welcomed and accepted as beneficial. In fact, all the research certainly that I've seen from the US experience is that it's well established. You now have a 20 years worth of people working in the corporate world who have only experienced SOX, and it's now become a very well-oiled machine in terms of implementing. The frameworks are very well understood. COSO is a pretty much globally accepted framework for internal control. It might not be perfect, but it's a very, very good starting point. And I think wherever we can use those frameworks that are already accepted and well used, we should use them. And I think any new framework coming from a European perspective should really take advantage of all the learnings and experience from implementing those systems. And I would absolutely echo the 3 lines model as well is incredibly useful as a tool for ensuring that any internal control model is well embedded, well understood, and so forth. But I think there are definitely advantages. I think, certainly from the US experience, the role of the external auditor and the independence of the external auditor is now well understood and well appreciated. There is much clearer accountability within organizations that have implemented a SOX framework, that the leadership is responsible for internal financial control, and there's no hiding from that. It's much clearer. Even down to the processes that sit underneath doing that assessment, it's much clearer, and as I say, the COSO model helps drive much of the thinking around that. But I think the overarching benefits is there's a balance to be struck. Some of the biggest learnings, certainly from myself and others close to this, is unless you take advantage of the technology that's now available to streamline the implementation of an internal controls monitoring framework, then it becomes an extremely bureaucratic and expensive process. And that's when the benefits start to some extent be diminished in terms of the costs. So it's really important for me, I think, to make sure that we ensure that we adopt or utilize as much as possible the existing terminology, the existing frameworks that are well embedded in many organizations across the world, and that we build on those and recognize fundamentally what they can do and what they can't do.
Thank you, Stephen. I think absolutely concur what you have been saying. I would like now turn to Rachel, because I think you have also what is your insight about the change would be useful for Europe, and maybe by I'm saying that I see from the questions coming in that there is some confusion between what is the UK SOX, what's the US SOX. I mean, and maybe you, coming from the UK, you may shed some light on this. And how would you judge the fact that in UK they want to water down the requirements, that in the sense that the assurance by an auditor is no longer mandatory, will no longer be mandatory? Because can you believe the directors for their word, and does this help to get the right tone from the top, so to say? Thank you.
Yeah, absolutely. To pick up that last point, what we were calling UK SOX, which won't be quite that now, absolutely, the element where mandatory independent assurance was watered down. I think you're absolutely right that actually as a board member, as a non-executive director, we want assurance to be confident in those statements that we're making publicly. So to me, it's good governance to have that in place, regardless of maybe what legislation says. You also mentioned that we have a question about confusion between different SOX. I think really at the moment we're using lots of things, and we're talking about UK SOX, EU SOX, and really all we're saying is countries or organisations or the Commission looking at applying something similar to US Sarbanes Oxley, but in their own context, I think. So I guess in the UK, we're using UK SOX as shorthand, but what we really mean is a framework of assurance over internal control, which probably leads me to my first point. You asked me about the view from the non-executive director. And probably some of these are really straightforward and simple. And I think we've already discussed them already today, but as non-executive director, I want it to be really clear what we mean by internal control. And do we mean just internal control over financial reporting? Do we mean wider internal control? Certainly the organisation where I'm audit committee chair, we talk a lot about internal control, and we mean both control over financial reporting and the wider risk assurance and type of control framework by that. But also we are going to see more public disclosures, and we have a question in the chat about ESG. We're seeing a lot more, aren't we? Sustainability reporting, environmental reporting, and I think some clarity, therefore, over what we mean by internal control, but then in terms of what we expect about public statements and public disclosures and reporting in different areas, and what we might expect in terms of control over those and assurance. I have to say, and this is, I'm probably biased by the fact I've spent 25 years as an internal auditor, but I would also really love to see the legislation really recognise global internal auditing standards, so that we have, you know, and this isn't just even about Europe, but globally, that type of recognised what do we expect from what is a really important source of assurance in so many businesses. And I think as a non-executive director as well, as the legislation changes, what do I want to see? I want to see clear timelines, but that are realistic, so we all can see what is expected and when. And I know that is normally the case, but to me, it has to be said that we need some clear timelines as legislation changes, and to some extent proportionality. Speaking just to the UK, where the government have implemented some type of further definitions of public interest entities, we now end up with 2 tiers of public interest entities. And I think therefore there has to be some proportionality. And I know we did see that in the US with Sarbanes Oxley as well, in terms of some of the requirements, but as a non-executive director and of a chair of an audit committee that will get caught in that second type of group, I think, yes, certainly some proportionality. And then lastly, and I'm not sure if this would come through in legislation, maybe it would come in the guidance about implementing legislation, I think for me is the clear responsibilities of management and not just those providing assurance. Probably enough for me, I think.
lot of food for thought. We have also, well, Maurizio, you happen to be Italian, and I use this because I think Rachel touched upon the management of the company. And I believe that in Italy, some changes were introduced with regard to responsibility of directors. And I think maybe that could give us some good basis also for the changes we may require at a larger scale in Europe. Maybe you could explore a bit on this.
Yes, it was a nice ice breaking on the topic, and I hope I'm not going to be confusing the audience by talking the Italian version of the Sarbanes Oxley. So we have the American, the UK, European, and now Italian. Nothing to be worried about, in the sense that the Italian version of the Sarbanes was introduced in 2005 as a result of the Parmalat case. The government, the parliament, was extremely concerned of the quality of the reporting and the reliability of the reporting of listed companies. And so basically they introduced a law 262 of 2005, which basically had provided for a few specific legal requirements in the area of corporate reporting. The first one was the introduction of a manager in charge of drafting the corporate financial reporting. So is a person that is specifically identified being responsible not only for drafting the financial statement, but also to release at the end of the process an attestation to the stakeholders, shareholders, but also the market, on the fact that the financial statements correspond to the documents available at the company premises and the accounting records. So this is the first attestation. And the attestation also brings inevitably the attestation that there is an adequate accounting and administrative system of procedures in place to guarantee that these information are sufficiently accurate and of good quality. Obviously, the manager by himself, the manager in charge, is not the only individual responsible, because it remains the ultimate responsibility, and is clearly stated by the law, of the board of directors about the financial statement and the information provided. By the way, not only the year-end financial statement, but press release and any other information that is released to the market during the year, including semi-annual accounts. So the directors and the board of directors and the manager in charge are jointly, in a way, responsible. So, and also the directors are responsible to make sure that the manager has a sufficient autonomy, budget, and resources to be able to implement the system of internal control over the financial reporting. In general, in Italy, the board member and the manager in charge refer to the COSO framework. There are different possible frameworks you can follow in setting up your system of internal controls, but the COSO is the one that has been recognized the most important, is the most utilized in general in setting up a system of internal control. I have to say that at the end of this long exercise, I can witness two different phases. The first phase was a bit of a panic because there was little understanding of the legal requirement. Suddenly, the specific identification of individual responsible for the financial statement information. And so there was a lot of many concerns on how to address this bigger responsibility. I have to say that after so many years of implementation, the situation is now much more relaxed, in the sense that now management in general understands that when you have to face problem of fraud or going concern, is much better and much more defendable if the rules are clear. You have been diligent in following that rules. You have been diligent in documenting the rules you followed, and therefore you can prove you have been diligent. In the past, you will still be held responsible. In the Parmalat case, all the management was held responsible, but the framework was totally unclear. So it was much more difficult for the directors. And I don't enter in the merit of the case because it was a difficult case. But anyway, in general, it's very difficult to defend your diligence and your position to the courts to the public prosecutor if you don't have a clear indication of what you were supposed to be doing. So you are always responsible. After this law, if those directors and those board of directors that have been diligent, spending some time and resources, obviously, to implement the system of internal control, are now much better positioned to defend their position of diligence. Unfortunately, fraud still happens. Going concern issues and bankruptcy still happen sometimes, but you reduce significantly the number of these episodes, and when these things happen, you have a better chance to defend your position. So I think that the journey was not easy. The journey was challenging for most board members, but I see now a much more structured and much more resilient system in Italy. And actually, Italy, strange enough, is the country that is being used in the benchmark activity of the research I mentioned before. So it's one of the few countries in Europe, actually probably the only one, that went so far in the implementation of a similar sandbox, and is the one that is showing the better results in terms of discontinuity on the cost of capital and the number of unusual adjustment to the financial statement. So once in a while is a good story and is a good example to bring to the audience, I think.
Grazie mille.
Prego.
Well, my Italian is a bit weak, so I won't continue in Italian, but I think I'm very grateful for this best practice from Europe. Because, as I said before, we haven't made up our mind in the Commission what to do next. We've had the public consultation. We are about to publish a study on the audit reform, the audit legislation. The study has been finished with some delay. Within 1 or 2 weeks, I hope we publish it. And it shows how complicated all the issues are and how intertwined and how interlinked all the issues are. And as I think to quote Stephen, there's no silver bullet. Huh? It's an evolution. It's not a revolution we're advocating here. But I think something which becomes very clear from this discussion is that a good internal control system is also an opportunity and a safety net for the board. And I think from the audit side, from the audience side, and from the consumer side, and from the investors side, I think we want an accountable board, and we want to hold them accountable. And it's also an opportunity for board members to have a system which are sufficiently robust and which can help them also to, as it didn't help in Parliament maybe, but it helped to create a better, again, a kind of safety net. So I think that's very useful. We have a few minutes left. I don't know whether some of the panelists whether there are some questions which we haven't addressed yet. I think the questions which are still in the chat are more or less addressed. Are there any panelists who are eager to step in let's put it differently, if we were to take some measures in Europe to amend our framework, where should we start? Should we start by, let's say, giving more clear responsibilities for the board or the management, or should we try to step up the obligations for the audit committee or for auditors, or should we aim for trying to do it all at once? Or Alain, can I start again with you?
Yeah, thank you, Roger. I think let me be very clear here, because we ecoDa, and I participate heavily with ecoDa's activities, and in the response to the consultation, we made our viewpoint very clear here. We think that the responsibility of boards and audit committees are very clear to that respect. What is not clear is what are the expectations regarding what is meant by an assessment of internal control within Europe. And again, a widely shared understanding of what this means. So it's a matter of, if it's a matter of just saying, you put a COSO type framework and in internal control, and that's what we mean by internal control. I think everybody will be happy with it. So the requirement is here. It's what's behind the requirement, the expectations, which is not clear. So and in doing that, I would very much, and echoing what has been said in the panel, I would very much welcome having that being done in 2 stages regarding regulation. First, clarify the requirements in terms of what do we mean by internal control, what are our expectations, and Stephen said something which I found very important. This is now investors' expectations. Our investors in Europe are expecting that companies beef up their internal control internally to standards which are now de facto standards, and those de facto standards are a SOX type, COSO type system of internal control and assessment of internal control. So very clearly having that requirement being clarified first, and if after 3 years, 5 years, a review process carried on by the EU on whether the target is reached in terms of whether internal control has substantially improved within European companies, then the EU considers whether we need to go with auditors' assurance or not. But doing this as a 2-step process, I believe, will be very much, very important for companies in terms of managing the overall process, and very beneficial to everybody in the ecosystem.
That's very clear. Somebody wants to react on this, or?
Yeah, I might echo Anne-Hélène recommendation and concern. Certainly, more clarity of what is expected by the directors in the implementation of the system of internal control is of fundamental importance. There are different possible frameworks, as I mentioned before, and that doesn't help the clarity and a uniform approach across Europe. Because we want a capital market union, we need to have similar framework to refer to and apply to. One important ask I submit to the authorities that we should refrain to regulate the introduction of this topic by, or addressing this issue by setting requirements that are going just being seen or perceived or read as administrative burden, but the system of internal control to be properly functioning has to be embedded in the way that management is managing the company and the company itself is run. So it's not just a series of controls, but this has to be part of the day-to-day work and the day-to-day activity of all the managers of the company and also all the employees of the company. In fact, one of the causal requirements of any implementation of a system of internal control is the information and communication of the procedures, the requirements to the whole practice, because that's the only guarantee or measure that can help a successful implementation and effective implementation of a system of internal control. It's not a bureaucratic administrative exercise ex post, but the controls have to be in place while you are managing the company, while you're doing your business.
I think there's 1 minute left. I don't know whether then the clock stops automatically, but Stephen, I saw you wanted to come in for a last word from you.
I would absolutely echo what the other panelists have said there, really. I think the important things for me is absolutely ensuring that responsibility remains at the board level. I think speaking personally, recognising the importance of internal audit in providing assurance over the internal control framework is also important. There would be the 2 comments from me.
Rachel,
last word from you, or?
I don't think I can add anything to that, the good comments made there.
Nor can I. So I would like to thank the audience, because I don't know whether it will stop here, but many thanks for the panelists for your for sharing your experience and your thoughts today. Many thanks to all of you. Bye-bye.
Many thanks. Have a nice day.
Thank you.
Bye-bye.
Bye. Thank you.